So welcome again. In this case, we have the honor of interviewing Dr. Jeff Ross. Jeffrey Ross is the founder and managing director of Vailshire Capital Management and Vailshire Partners. Under the state of Colorado's Division of Securities, Vailshire is a registered investment advisor created by Dr. Ross to grow and protect its clients' wealth via wise and innovative investment strategies using a full cycle macroeconomic approach. Dr. Ross is a fellowship-trained interventional radiologist and currently serves as a board-certified diagnostic radiologist. Passionate about investing wisely and teaching others to do the same, Jeff is a former contributor for The Monthly Fool and occasionally contributor for Seeking Alpha. The hedge fund and individual Vailshire client portfolios enjoy the distinct advantage of benefiting from Dr. Ross's expertise and knowledge of all things healthcare and technology related. As it relates to the performance of the fund, he just knocked it out of the park, actually, because over the last 3 years, the annualized return is almost 30% annualized return in 3 years, and 5 years, 64%. It's kind of crazy. And then from the inception, that was back, I think, in 2014. He has made annualized returns of almost 15%. So it's really, really great performance. So Ross, welcome to the Jeff. Welcome to the show. And my first question relates to your two declared passions, investing and radiology. So, can you walk us through these two antagonic worlds and where they meet each other, so you can benefit from the two of them in the investment field?
Sure. That's a great question. First of all, Ivan, thank you for having me. Michael, thanks, you guys. I appreciate the opportunity to be here. We can dig right in. So regarding radiology and investing, I would say that actually they're more alike than you would think they are. And to start out, you have to be an expert in both of these fields. You have to have an incredible attention to detail. You have to have a tried and true evidence-based systematic process. And then you have to have the ability to pull together lots of small clues to understand the big picture. And so, like, similar to when I'm reading a radiology exam, I look at what does the liver look like? What are these little lesions doing in the liver? What does the pancreas look like? What about the appendix? And then you put that whole picture together and you come up with a diagnosis of what's going on with the patient. Investing, I think, at least the way I approach investing, it's very similar. I come from a macro background, even though I originally started as kind of a value investor, but then I switched over to where my kind of skills are, I think, and switched to a macro perspective. And so what I love to do is put together tons of little pieces every day, look where the market's going, look at what the economy is doing, look at what different companies are doing, look at trends in the market, put all of those together and create an overall investment thesis. And that has worked pretty well for my hedge fund and for my Vailshire clients as well over time.
Definitely.
So what's the so given that, what's the mosaic telling you right now? I mean, because kind of that blend of the top down, bottom up, I think is most interesting kind of at turning points, and it seems like we might be at one of those turning points.
Sure. I will say, so a couple thoughts. First of all, I think the narrative right now has been that people have been concerned of the very stretched valuations in equities, especially U.S. equities. And then even treasuries as well, and have been concerned about a pullback of size. And I think I have disagreed with that, at least in the way I've been investing over the last several months, is based on the underlying indicators I'm seeing. I think we're seeing accelerating GDP, we're seeing accelerating inflation. And when you get those factors together, that tends to actually be a great environment for stocks. Even though they are overvalued, I think that they'll become even more stretched, more overvalued over the coming months. I think that treasury yields are going to continue to rise, meaning the prices are going to fall, and it's going to continue to be a tough time to hold U.S. treasuries. I think commodities are going to do very well. and the dollar in general is going to weaken. I think risk on assets should do well. So Bitcoin, as we brought up earlier, that's one of the things I like to invest in. I think it's going to continue to do well. All of this for the next few months. My investments change and my theses change as the underlying data changes. And so we'll see what's next, but I'm actually kind of bracing and preparing my own clients for it may be a tough summer and fall, but that remains to be seen.
Mm-hmm. And what do you think would be the catalyst there? What kind of those factors, would it be kind of a gross slowdown after kind of this initial kind of reopening wave? Would it be inflation going from kind of benign to more problematic? What if you had to guess right now, kind of which of those variables are you kind of most sensitive to?
Yeah, that's great. So I think the two variables that I'm most sensitive to is the GDP accelerating or decelerating year over year? What's the rate of change? Mm-hmm. Also with inflation. And so I think what we're going to see in the second quarter, the quarter that's coming up, and obviously the markets always look ahead, so we're starting to feel that in the markets a bit. But I think the second quarter, we're comparing to last year when COVID first hit and shut down the economy. And so we're basically coming up to very easy comps. After that, though, the third quarter, that's when the rebound started to happen. And when we get to those comparisons, I think it's actually going to be tough to beat those. I think we're going to be surprised to the downside, even though the narrative that I'm reading, at least in the popular media, is saying that once the vaccines are fully distributed throughout the economy and COVID is kind of taken care of, then the stock market's going to, rise much higher. It's going to be good times for everybody. I think actually the opposite. I have a bit of a contrarian view on that.
Mm-hmm. Interesting. Great. Thank you.
Just my take, obviously, just a guess, but we'll see.
Yeah, sure. Anyways, I mean, it's interesting because you have been talking about macro, also about value investing. I remember we interviewed Jesse Felder, and he was talking about this idea of blending fundamentals, value investing, especially with technicals, looking for reversals and stuff. So, but in your case, I've seen also that you kind of use technicals in one way. I'm not sure exactly the way you use it, but it's interesting to see that you are blending different approaches, especially macro side, but also with value investing and these technicals. Can you elaborate a little on that part of the analysis, if you use it a lot, not, and the way you use this kind of analysis?
Sure. Well, first of all, I got to say I'm good friends with Peter Brandt, who's kind of a famous technical guy. He's been around and he's been writing the book on technical analysis for decades. The things that I do and the charts that I post on technical analysis basically make him roll his eyes and sigh all the time. And I don't do good technical analysis, but that's intentional. That is the thing that I consider the least out of all of my investment decisions. So the way I do my technical analysis is I have my macro view and I have other factors. So, and then and Bitcoin is a good example. I post technical charts every day on Bitcoin, but my technical charts are completely based on my macro view and the on-chain analytics. So what I think Bitcoin is doing in the big picture, I make my trend lines and things to fit with my concept of what's going on. And if I feel like those trends, the momentum is shifting and my macro view is shifting, then I'll shift my technicals along with it. So I don't know if that answers your question, but I certainly don't consider myself any kind of a technical expert. But I have a good time pretending that I'm a technical expert and
No, it's interesting because I mean, it's a smart way to use very likely those kind of skills, if you have them and you use them wisely, so it makes all the sense. And actually, this was Jesse Felder was talking about also this idea of blending both, looking for in his case looking for reversals, and in your case to support your macro analysis. So it makes all the sense. It's a smart way to use it. I take it. I'm not an expert either, but I understand this point. Super interesting. Yeah.
Yeah, thanks. I guess one other way to put that is I basically have very little conviction in the technical factors, and they have to fit my macro view in order for me to actually use those. And if they do, that's great. It often works out well.
And Jeff, why don't you elaborate a little on the Bitcoin thesis? Because lately I saw that it was, as per your opinion, it's in the long haul, it's a super bullish, but in the short run, maybe it could go, let's say, up to 33,000. You mentioned, I take it, I'm not sure, but it's a big range. So what's your idea behind this analysis, this thesis? What do you think about Bitcoin?
Sure. Well, that's a huge topic for me, but what do I think in general? I'm highly constructive on it. I'm definitely in the bull camp. There are groups of people on Twitter that are called Bitcoin maximalists. I'm not a maximalist, but I am a Bitcoin fanatic. I truly believe that it's here to stay. I think that it is the financial network.
What's the distinction?
The distinction is that I don't.
What's the distinction between a Bitcoin bull and a maximalist?
Well, a Bitcoin maximalist only invests in Bitcoin. They hate all other cryptocurrencies. It's blasphemous to even talk about something like Ethereum, talk about other altcoins and things like that. They are, and by the way, I have tons of respect for these people, so I don't mean to slam on them, but I'm just not like that. They're very dogmatic, and Bitcoin is the only way, and that's all you need. I tend to think, well, as an investor, especially, I look at everything. I'm pragmatic. I look at what asset classes could provide alpha for my clients, what could be a good long-term investment, what could be a good short-term investment. I'm happy to go anywhere as long as I understand the asset class. So that's why I call myself a Bitcoin fanatic. But I also am a believer in the rest of the cryptocurrency space to some degree, if that makes sense. So Bitcoin itself, why I'm so enthused about it, I really do think it's the financial network of the future. I think that it has basically already reached escape velocity as far as the users who are coming on board. I think of it akin to the internet back in the mid 1990s or so. That's about where we are in Bitcoin right now. And I think as it goes from the early adopters to kind of the general use within the public, it's just going to continue to explode higher as people see its benefits and the benefits in particular of how it's different from government fiat currency and the use case as a store of value. So that's my general thought on Bitcoin. I'm highly constructive on it.
Is there a dynamic with Bitcoin though, where, because you kind of have, what I don't really understand is kind of the price versus volume discussion. So like, adoption is one thing, but price is another, and so I can certainly see Bitcoin, kind of having a place in, say, portfolios as an inflation hedge, like gold has traditionally done. I can see Bitcoin kind of from an asset allocation standpoint. I understand that. From a digital transaction standpoint, I also see that. But what I don't necessarily see is why increasing adoption has to equal kind of ever higher prices. And so to me, that's a disconnect that I just don't understand it, and
Sure.
why that logically follows.
Sure. Well, I guess the quick answer in my mind is Metcalfe's law. So as the network grows, so too does the value of the network, and exponentially so. You can think of that in terms of, telephones. People used to talk about when, one telephone by itself is worthless. If you have two phones, now suddenly it has value because you can call each other. As the network grows, it exponentially grows in value. Now, value does, as Mark Yusko says, I don't know if you're familiar with Mark Yusko, he says price is a liar. And I think that's fantastic because price ebbs and flows and it goes crazy all the time. And, we're in a bull market right now, so everybody's going crazy about the price of Bitcoin. To me, I don't really care. I look at what is the long-term value and where I think the market capitalization of Bitcoin should go over time. And I think eventually that price follows. As it becomes more and more widely adopted, the value intrinsically grows, the use cases grow, and then the price will follow. To how high, I have no idea, but I think it's much higher from here.
So I was talking about this with some friends the other day, but Bitcoin's market cap kind of briefly breached $1 trillion, right? And the U.S., if you look at the Federal Reserve, they currently have 11 trillion in gold reserves. So one could say Bitcoin is now 10% as viable or 10% as trustworthy as the U.S. dollar. And what I would say is when I look at the network effects of people who have adopted the U.S. dollar as a means of exchange and a store of value, it's quite a bit larger than the network that has adopted Bitcoin. And so what I'm wondering is, whether that 10% kind of legitimacy factor is maybe just a little bit high. I think Bitcoin is legitimate. I think the network is very large. I think it is growing. I think it will continue to grow. But whether it's kind of 10% as legitimate as the US dollar, and again, I mean, that is a super broad, obviously, I mean, because, it's hard to do kind of true fundamental analysis on Bitcoin, but you're just kind of using that as an, observation, a pole in the tent, a 10% legitimacy factor versus the dollar seems maybe a little bit ahead of fundamentals.
Sure. Yeah, I hear you.
Just
I
an
agree
observation.
Yeah, exactly. And one point you brought up that I'd like to piggyback on is I often tell people to quit thinking about Bitcoin like it's a stock. That really throws off traditional equity investors, especially value investors. Like, well, how do you value it? It doesn't have cash flows. I'm like, it does. Of course, it doesn't have value. That's not what it is. It's not a company, exactly. And
it is
so
not a company, exactly.
Exactly. So you have to change your way of thinking about it. And what I've learned in my, I've been involved with it off and on since about 2015, and I've watched the narrative change over time. I still remember the day that Bitcoin reached parity in price with an ounce of gold. I couldn't believe it. I thought it'll never happen. And then it did, and it was amazing. And I think that to me, the next goal, and it's kind of what you brought up, parity with the market value, the market capitalization of gold in the world. And I the way I understand it, that's about 10 or 11 trillion dollars. And so I think that's sort of the next milestone that Bitcoin is reaching. And then, you know what, I think it's actually going to reach that down the road, not this year. I'm talking, 5 or more years down the road. And then I think the narrative will change again. I think once people are okay with it being gold 2.0 and it's okay to have it in modern portfolios as an inflation hedge, things like that, then the narrative will change and it will move on. But we'll see. It's hard to predict that far out in the future.
Yep. No, we'll see it. It's fascinating.
Yeah.
Totally. Yeah. By
so,
the way,
one kind of, sorry, go for it, Ivan.
Okay, just this is the last question of my last question, at least of this first part of the interview, and I'm interested in understanding the other themes that you happen to invest. Because you have been talking about Bitcoin. This is clearly, I mean, it has gone up incredibly, but also other technological or technology-related themes, like for instance, automation, robotics, AI, and also healthcare, genomics. So there are a few platforms that are kind of disruptive, innovative, and really they have gone kind of through the roof over the last decade in comparison to, for instance, the typical value companies. And so I want you to elaborate a little on this kind of themes, because you are specialist in this healthcare side and also technological related. So can you elaborate a little on the general themes that you happen to invest?
Sure. I like I mentioned earlier, I actually came from a value investing background, and that actually shows in the first few years of my hedge fund were actually pretty painful. My results weren't great. And it took me a few years, and I think it has for a lot of value investors is the reckoning that, man, value investing just is not working. At least the last decade, it hasn't been working very well, traditional valuation metrics. And so I spent a ton of time studying and trying to figure out why it doesn't work. Now I have my theories about why it hasn't worked. One of them is that I feel like the US dollar, so the base currency that we base all of our formulas on, our price to book and price to sales and PEG and cash flow discount model, all of these models that we use are all based on the US dollar, but the US dollar is depreciating so quickly and it's so volatile because of all of the actions. And we don't have to get into all this, but all of the things that the central banks are doing to weaken their currencies and to manipulate the interest rates, things like that. I think it really throws off all of these calculations and it makes them almost useless in a way for now.
Yep.
It's someday they won't, someday they'll work again. But I also think that because interest rates are so low, borrowing money is practically free. In places in Europe, you actually can get, you have negative interest rates. It doesn't do any good to have a huge stash of cash. It's actually smarter to borrow money to accumulate huge amounts of debt. And then if you can use that to grow your company really quickly, that's actually the way to do it these days based on the current macro environment that we have. So that's why I think companies like the FANGs, Tesla, these other companies that they just borrow money and then they grow like crazy and people can't get enough of them. And these old stodgy, cash gushing companies, the value companies, nobody cares about these because they're not growing. They're basically flatlined and they're not doing much with all of this available credit that's out there. And so they've just been getting left in the dust for the last decade. Now, at some point, this system is going to have a day of reckoning. And I think that this next decade is going to be extremely difficult. And a lot of this stuff is going to change over the next decade. I think it's going to be a lot like the 1970s, where stocks basically went nowhere. They just chopped up and down for about 10 to 12 years. And bonds were a terrible investment because interest rates are choppy, but also most kind of starting to rise because of inflation. And I think inflation rate related things or stagflation related entities are going to do very well. Commodities, gold, again, Bitcoin, and hard assets. So that's a preamble to about my investing in healthcare and technology. That's where I like to invest. Those are my favorite areas to invest, but I will go anywhere that I can find alpha for my clients. If I think I can safely generate alpha in Bitcoin, I'll jump into Bitcoin, and if I understand it. So I have to make sure I understand it first. But if technology and healthcare stocks are looking like they're gonna crash because of what my underlying metrics are telling me, I'll get out. I'll go to neutral. I'll short the same stocks that I'm a fan of today. I'll short them next month if it comes out.
I think one of the challenges of the current equity market is the perhaps growing disconnect between what's a great company and what's a great stock. And I think there are a lot of phenomenal, just absolutely incredible companies, but when they're trading at 20 times, 30 times revenue, and real interest rates are starting to rise, perhaps in a manner which accelerates, that can become problematic. And like we saw with Microsoft, in 1999, Microsoft was growing revenues at 20%. It continued to grow revenues at 20% throughout the 2000s. But when it entered the decade trading at 25 times sales, it exited the decade trading at 4 times sales.
Exactly.
And so Microsoft obviously continued to be a great company throughout the 2000s and reinvented itself to once again become one of the truly exceptional companies globally. But again, over those 20 years, it grew 20% annually revenue. But obviously, it didn't necessarily translate into a consistent, equity performance. And so that's going forward. And I think that is, we're it's the top of the first inning, I think, of this kind of transition from what has been working and what will continue working as on a fundamental basis versus what's going to work as an expression in the equity markets. And so I think it's going to be I agree, it's going to be an interesting decade.
Absolutely.
Actually, there's a point that I'm going to keep for our next interview, because one part of this, my take is that one part of this, it has to do with the intangible assets, because these kind of companies, the value companies, traditional value companies, maybe they don't have this amount of intangible assets, but all of these new themes that are kind of disrupting the market, one part of the valuation can be set on this kind of intangible assets and the difficulty of evaluating that, because what Michael said, this idea of, okay, this company can be priced at a very high, P or whatever, but eventually what part of this valuation is not taking into account the intangibles, and how do you measure these intangibles? Maybe in the next interview, I will ask you, Jeff. Okay, so we are gonna leave it here, if you don't mind, and if you. As you know, Jeff, this has been a pleasure. Thanks a lot for attending this this interview. And I mean, these kind of topics are awesome. I hope our audience is. I think our audience is going to enjoy a lot. And thanks a lot for coming here and sharing your thoughts and your knowledge with us. Thanks a lot, Jeff.
It was really my pleasure. Thanks for having me, guys.
If you want, in this case, I'm going to speak in Spanish to say goodbye. If you like this interview, if you like this kind of proposals we bring to the channel, of course, click the bell, subscribe to the channel, and share this video or the other videos you like in the channel. See you in the next Casting Strategies program.